Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So I got an interesting article here for you. Comes out from betterdwelling.com. I'll leave the link in the description so you could read up on this article, but it's titled Toronto Mortgage Delinquency Rate Hits a 9-Year High. Now what happened here, right? We've seen delinquency rate moving up while rate cuts are, we're seeing rate cuts from Bank of Canada. I thought that's supposed to solve everything. I thought everything about rate cuts and how that's going to save the property market and people are going to be buying like crazy. I thought that was supposed to come by now. Well, let's read up in this article and see what they're saying here. It says Toronto real estate just got another sign that it entered into one of the most roughest markets ever. Equifax data shows Greater Toronto mortgage delinquency rate climbed again in Q2 2024. Just 2 years after hitting a record low, the rate is now climbing at one of the most aggressive paces in history, hitting a 9-year high in the latest data. Mortgage delinquency rate is the share of total mortgages at least 90 days past due. Okay, so more than 2 months of missed payments, you'll be part of this data of the mortgage delinquency rate. So more than 90 days past due, you're part of this rate, and it's one of the most discussed important economic indicators, but also one of the most misunderstood. Now, why is it misunderstood? Let's read further. Most people think a rising delinquency rate means households are struggling. Not necessarily the case, since most people will just try to sell their property before the mortgage becomes delinquent. In a hot market, a distressed seller can sell the property and often make money before a mortgage turns delinquent. Mortgage borrowers only tend to default when they can't dispose of the property in a timely fashion. In short, it's less of a sign of consumer health and more of a sign of market liquidity. Are we in a hot market? Question for you guys. Are we in a hot market? Are we seeing that, you can sell your property very fast, very quickly, very easily? Does that show signs of liquidity? I completely disagree with this article here, saying that, sure, it might be misunderstood in a bull market or a hot market, but I don't think we're in a hot market, right? Just look at the Toronto condo market. All these condos are coming up for sale. All these condos, the massive supply in Toronto, you're seeing even in the rent is being dropped drastically. Why? Because you got all the supply of condos and people are trying to compete with each other. People are not renting them out, very few are, and to be competitive, what you have to do is cut your rent, reduce it, and then if you're seeing other people are doing the same, you'll do the same as well. Now, this is not a problem right now. However, this can be a problem down the road when a recession hits or when the unemployment rate skyrockets, right? Which we're seeing right now in Canada. The unemployment rate is picking up quite drastically. All it takes is just an event for it to just pop and things to get worse. So the delinquency rate moving up is a telling sign, is an important sign. The fact that if you can sell your property at, break even or some sort of profit, that's great for you or whoever is selling it, but it doesn't necessarily mean it's a good sign, right? And what happened to all these rate cuts that Bank of Canada has done, and it was supposed to save the property market, we're supposed to see a big bull run? What happened to that? We've had quite aggressive rate cuts so far. We've seen 50 basis points of cuts in one meeting from Bank of Canada, yet the delinquency rate is going up. Yet more supply is going up, right? What is it? Just liquidity? People want to sell? Why? Why would you want to sell? I thought the narrative is that when rate cuts come, housing to the moon. We're going to see a boom all of a sudden. But this is the problem. What people don't understand is this is how it starts. First, you're slashing rate cuts slowly, eventually to a point when things get worse, things are a little bit standstill, it's quiet. People are going to argue, oh, don't list your house during Christmas time. No one's really going to be looking around. Post it in a different time and things are going to get better. Not necessarily true when you look at previous data and history, especially when you look at the bond market, the yield market. You're looking at the steepening in the curve, and when you look at past history with the unemployment rate moving up as it creeps up higher, and when you get those rate cuts happening, eventually you will see a topple where you'll get aggressive emergency rate cuts, which is what is the meaning behind aggressive rate cuts? Is that, oh, the times are good, that, oh, things are fine, right? No, you're doing aggressive rate cuts because there's a problem, right? And when a problem comes, companies start to lay off workers, you're unable to make those mortgage payments, you're going to sell those properties as fast as you can and even take a big a loss, which we're already seeing right now in the markets. It's happening slowly and quietly. And while it's happening slowly and quietly, all of a sudden you'll get the big kaboom, right? So I'm not saying that, it's over forever. It's just how the cycle works. You get the expansion, you get the peak, then you get the recession, right? The contraction, you got the trough, and then again, you're recovering, expansion, peak, and the cycle repeats, right? The economic cycle. So we are about to experience sooner or later some sort of recession or big boom or an effect in the economy, some event. We don't know what and where and how it'll come, but the signs are there, the cracks are there. You're seeing it. Just go on realtor.ca, you're seeing it there. You're seeing it in the delinquency rate, and it snowballs. It happens slowly. We all know about it, right? It's just like 2008, 2007, 2006, right? 2006, 2007. We all know about it. The property market was hot. 2008, it's hot, right? And then until when, right? Until the end of 2008, when things just went boom, exploded. That's how it works. So that's my 2 cents. You could read up more into this article, but it's a telling sign that it's at a 9-year high. You have the bond yields on the long end, ones that are more connected to mortgage rates. Those are moving up while rate cuts are happening, right? That's another telling sign. You've got the steepening happening as well, especially in the U.S. as well. We got some U.S. economic data that came out today, a little bit better than expected. And then you got geopolitical tensions, Trump coming in. There's so much that could just create an event that could trigger all of this. So there's problems, there's signs of problems. It's just the thread is so thin, right? That it just takes something to just break it. And then that's it. And then it starts collapsing, right? So it's all there. We'll go further into this in details more as more data comes out. We'll look at Canadian data as well, US data. They're all connected. All these countries are connected together. They're all important. If you want to be tuned into that and learn more, hit the subscribe button, the like button, bell icon to be notified on the next video. And I'll be discussing more as more data comes out. So anyways, let me know what you guys think. Leave a comment below. What do you guys think about this mortgage delinquency rate? What do you think about the real estate market in Toronto or any other place that you may be? Are you seeing some signs there as well? Are you worried? Are you not? Do you think that, okay, we're going to get a bullish move higher and, the blip will be very temporary, or there may not be any massive correction or small correction? Whatever the case may be, leave a comment below. Let me know your thoughts. We'll talk soon. Cheers.